Small savers who had missold preference shares at state-owned bank Bankia stood to lose 75% of their investment as shares dropped to an all-time low of 54 euro cents by midday on Tuesday. More than 11 billion shares issued as part of a 15.5 billion euro recapitalisation of the Spanish bank started trading on Tuesday at 7 a.m. in what was meant to be the new beginning after a 24 billion euro bailout last year. Following the cash injection, the Spanish state owns 68.4% of Bankia, with the rest held by former holders of preference shares and hybrid debt, often small savers who had missold these complex financial instruments and were forced to swap them at a discount for ordinary shares. The ordinary shares were issued at 1.35 euro, but were trading at the initial price of 60 euro cents on Tuesday, falling to an all-time low of 54 euro cents by midday. Analysts expect the price to settle somewhere between 45 and 60 euro cents, and have little hope of a quick recovery, as tough business conditions and a challenging restructuring plan weigh. On Tuesday, about 150 preference share owners, mostly retired, gathered outside a Calle Madrid branch, part of Bankia, in central Madrid to demand their money back after being missold preference shares as secure investments. Despite the losses, most savers who brought preference shares and hybrid debt are now expected to sell their new shares on Tuesday to try to recoup part of their money. This, however, is expected to add downward pressure to a stock which already lost more than 50% last week, when institutional investors triggered a mass sell-off as they received their shares. Further pressure on Bankia will come from a recession which economists expect to last at least another 2 quarters. The bank also needs to pay back public aid and cheap ECB loans received last year, and faces a possible new round of provisioning to cover losses on the refinanced loans portfolios.